Crypto isn't just going to crash, it's going to collapse by 90%. And the warning signs are flashing red everywhere, but almost nobody is connecting the dots. In October 2025, the crypto market suffered the largest liquidation event in history. 20 billion wiped out in 24 hours. Bitcoin dropped 14%, Ethereum crashed 12%, altcoins plunged 50–90%. And this wasn't just a normal correction. This was a stress test that the market failed. Here's what nobody's telling you. The leverage in crypto markets has reached insane levels. Some exchanges are offering up to 1001.1 leverage. That means you can control over 1 million in Bitcoin with just $1,000. And there's currently 787 billion in outstanding leverage across perpetual futures. That's almost 6 times more than the $135 billion in spot Bitcoin and Ethereum ETFs. The SEC just blocked multiple companies from launching 3x and 5x leveraged crypto ETFs, saying that leverage is clearly out of control. Daily liquidations have tripled compared to the last market cycle, and analysts are now comparing the current market to 1997, 2 years before the dot-com bubble burst. But here's the scariest part. Crypto has crashed 80–90% in every single previous bear market. In 2018, Bitcoin dropped 84% from peak to bottom. In 2022, it fell 77%. Ethereum has crashed over 90% twice. And altcoins? Most of them lose 95–99% of their value and never recover. The October crash wasn't the main event. It was a warning shot. And in this video, I'm exposing the 5 reasons why crypto is about to crash 90%, which coins will get destroyed, and exactly what you need to do right now before it's too late. Because when this crash happens, it won't just wipe out leveraged traders, it will destroy entire portfolios and take years to recover. The leverage time bomb. But there's one thing about the current crypto market that is by far the most dangerous, and yet most investors are completely ignoring it. It's the leverage explosion. And when you see the actual numbers, you'll understand why this is a ticking time bomb waiting to detonate. Let's start with what happened in October 2025. The market suffered 19.3 billion in liquidations within just 24 hours, the largest liquidation event in crypto history. This wasn't a slow bleed. This was a cascade where one liquidation triggered another, which triggered another, creating a death spiral that erased $370 billion in market value almost instantly. But here's what caused it: excessive leverage. FedWatch advisors Ben Emmons told CNBC that there's leverage up to 200x on some Bitcoin exchanges. Some platforms like Hyperliquid and Aster were offering leverage up to 1E1.1. Let that sink in. You could control over 1 million in cryptocurrency with just $1,000. And here's the scale of the problem. There's an estimated 787 billion in outstanding leverage in perpetual crypto futures. Compare that to only 135 billion on spot Bitcoin and Ethereum ETFs. That means for every dollar of real institutional money in ETFs, there's almost $6 of borrowed money in leveraged positions. Emmons warned, there is still a lot of leverage in Bitcoin out there. We can expect some more of these liquidations if Bitcoin prices don't get off the lows from here. The liquidation data tells the full story. According to Glassnode, average daily long liquidations have jumped from about $28 million in the last cycle to roughly $68 million today. That's more than double. Short liquidations have also risen from around $15 million to $45 million per day. What this means is that the market is now so leveraged that even small price moves trigger massive liquidations. A 10% drop in Bitcoin doesn't just hurt holders, it wipes out leveraged longs, which forces selling, which drops the price further, which triggers more liquidations. It's a self-reinforcing doom loop, and it gets worse. The SEC just took unprecedented action in December 2025. They sent warning letters to multiple ETF issuers, including Direction, ProShares, and Tidal, blocking their applications to launch 3x to 5x leveraged crypto ETFs. The agency said these products exceed the 2% exposure limit allowed under the Investment Company Act of 1940. Bloomberg ETF analyst Eric Balchunas said the SEC's move was honestly for the best because these leveraged products would constantly lead to termination events. The COBC letter, a prominent financial analysis firm, responded bluntly, leverage is clearly out of control. Think about what this means. The SEC, the same regulator that approved spot Bitcoin and Ethereum ETFs, is now saying that the leverage in crypto markets has gotten so dangerous that they won't allow new leveraged products. That's not a vote of confidence. That's a red flag. And here's the behavioral problem that makes this even worse. According to FedWatch advisors, the crypto market is predominantly retail-driven, and retail reacts very differently than institutional investors. What that means is that when panic sets in, retail investors don't have risk management systems. They don't have stop losses. They just panic sell. In October's flash crash, over 1.6 million trading accounts were liquidated. That's not a few big players getting wiped out. That's over 1 million individual retail traders losing everything in a single day. The crypto market is now a powder keg with $787 billion in leverage, minimal institutional guardrails, and millions of retail traders using 10x, 50x, even 200x leverage. All it takes is one more shock, a regulatory crackdown, a major exchange hack, a geopolitical event, and the entire structure collapses. But even if leverage wasn't a problem, there's a fundamental market structure issue that makes this crash inevitable. The October flash crash was a coordinated attack. This next piece of evidence I'm about to share is perhaps the most disturbing because it suggests that what happened in October wasn't just a market panic, it was a coordinated manipulation. It's what on-chain investigators are calling an Oracle manipulation attack. And when you understand how it worked, you'll realize that the entire crypto market is vulnerable to being weaponized. Here's what happened. On October 10, 11, 2025, the crypto market experienced what looked like a sudden sell-off triggered by President Trump's tariff announcement on China. Bitcoin crashed. Ethereum crashed. The narrative was that investors panicked over trade war fears. But on-chain investigator I discovered something shocking. A single whale, one massive trader, had been setting up short positions for weeks. Between August and September, this whale sold over 35,000 Bitcoin for Ethereum through Hyperliquid. Simultaneously, they placed 735 million in short Bitcoin orders on the same platform. When the crash happened, this whale reportedly held 1.1 billion in short positions and profited over 80 million in just 24 hours. That's not panic selling. That's a planned attack. The attack worked through Oracle manipulation. Oracles are the systems that tell smart contracts what the price of an asset is. If you can manipulate the Oracle price, you can trigger liquidations even if the real market price hasn't moved that much. What appeared to be a $60 million sell-off was actually an intentional manipulation designed to cascade through the system. Here's how it worked. The initial dump pushed the Oracle price down. This triggered liquidations for anyone using leverage. Those liquidations forced more selling. That pushed prices down further, which triggered more liquidations, and the cycle repeated. The result? 19.3 billion in liquidations, the largest in crypto history, and it was a 160x amplification of the largest previous Oracle attack. Financial Times published a diagram showing how these attacks work. The pattern has been the same since 2020. Identify Oracle dependence on a manipulable source, calculate the manipulation cost, execute, and profit. What made October 2025 different was the scale. This was an institutional-level attack on a system with massive hidden leverage. And here's the terrifying part. The system amplified the attack because of several vulnerabilities. Hidden leverage through yield programs that encouraged recursive borrowing, creating positions up to 10x based on collateral. Concentration risk, where the oracle relied too heavily on a single exchange's spot price. And infrastructure failure. The initial cascade caused a server-busy state, creating a liquidity vacuum as market makers couldn't place bids fast enough. Jay Goldberg from Seaport Global Securities questioned whether major companies like Nvidia are actually investing or just subsidizing demand through circular deals. The same logic applies here. Are these liquidations organic market movements? Or are they being manufactured by sophisticated players who understand how to weaponize the system? Reports suggest that a wallet which transferred gas for the whale's activity also moved 1.31 million USDC to a research firm's Binance deposit address, suggesting potential advanced knowledge or data exchange. While not all details are confirmed, the highly organized pre-positioned shorts and the principal's background add deep suspicion to the crash's planning. Blockchain Magazine noted that algorithmic trading bots, which can execute stop losses in milliseconds, only accelerated the decline. When you combine human-initiated attacks with bot-driven selling, you get crashes that move faster than humans can react. And here's what this means for future crashes. If one whale with 1.1 billion in shorts can trigger 19.3 billion in liquidations, what happens when multiple whales coordinate? What happens when nation-states decide to attack crypto markets? What happens when the next crisis hits and there's even more leverage in the system? The October crash demonstrated that crypto's financial structure can be weaponized like code. Analyst Ross Hendricks from Porter & Cummer told The Washington Post that ChatGPT and crypto are experiencing similar problems. They were early winners with inability to truly monetize and break away from the pack, just like MySpace. The crypto market isn't just overvalued, it's structurally fragile. And when the next attack comes, whether from a whale, a hack, or a coordinated short, the cascade will be even worse because leverage has only increased since October. But the attacks and leverage aren't even the worst part. There's a macroeconomic force that's about to crush crypto. The Fed rate reality check. Here's the macroeconomic reality that's about to destroy crypto prices, and it's something that most crypto investors are in complete denial about. It's the Federal Reserve, and their stance on interest rates is about to pull the rug out from under the entire market. Let me explain what happened. In October 2025, Fed Chair Jerome Powell cut interest rates by 25 basis points. Crypto investors celebrated. They thought this was the beginning of an easing cycle that would pump liquidity into the system and send Bitcoin to $200,000, but Powell immediately threw cold water on that fantasy. He said there were strongly differing views among Fed officials about future rate cuts, and he added that there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle. Translation: don't expect more rate cuts anytime soon. Michael Barr, a senior Fed official, was even more explicit. He warned that the Fed should proceed cautiously with interest rate cuts because inflation is still around 3%, well above the 2% target. He said, we need to be careful and cautious now about monetary policy because we want to make sure that we're achieving both sides of our mandate. And here's why this destroys the bull case for crypto. Bitcoin and other cryptocurrencies are risk assets. They don't pay dividends. They don't generate cash flow. Their only value comes from the expectation that someone else will pay more for them in the future. When interest rates are low and near zero, money is cheap. Investors take that cheap money and plow it into risky assets like crypto, hoping for big gains. But when rates are high, and right now the real yield on 10-year treasuries is 2.32%, the highest since mid-2024, the opportunity cost of holding crypto becomes enormous. Why would a rational investor hold volatile, non-yielding Bitcoin when they can get guaranteed 4 to 5% returns in treasury bonds? The answer is they wouldn't unless they believe Bitcoin will appreciate more than 5% per year. And with all the leverage, crashes, and regulatory crackdowns we're seeing, that's becoming a harder case to make. The data backs this up. After the October rate cut, Bitcoin and Ethereum still fell. Bitcoin dropped from around $111,000 to $85,000 in November, a 25% decline that was Bitcoin's worst month since 2022. Clearly, the rate cut didn't help. And here's the kicker. Fed projections for 2026 now show only one rate cut at most, and policymakers remain divided on even that. JP Morgan acknowledges that expectations for 2026 remain highly uncertain. Compare this to what crypto investors were pricing in earlier in 2025. They thought Trump's election would lead to aggressive rate cuts, a weak dollar, and massive liquidity. None of that is happening. Trump hasn't replaced Powell. Powell is maintaining a restrictive monetary policy, and the dollar index is hovering near 107.8, very strong. This creates a perfect storm for race. Crypto. High rates increase the opportunity cost. Strong dollar makes risk assets less attractive. And sticky inflation means the Fed can't ease even if they wanted to. Look at what happened after previous Fed easing cycles. In 2019, the Fed cut rates and crypto rallied. In 2020, rates went to zero and crypto exploded. But in 2025, rates stay high and crypto crashes. The correlation is clear. The macro environment that crypto needs to thrive simply doesn't exist right now, and it won't exist in 2026 either. And if high rates weren't bad enough, there's one more structural problem that guarantees this crash: the retail panic selling death spiral. Here's the behavioral pattern that turns every crypto correction into a catastrophic crash, and it's built into the market structure itself. It's what happens when 96% of your market is retail investors with no risk management. And when panic sets in, there's no floor. FedWatch advisors spelled this out clearly. The crypto market is predominantly retail-driven, that's the worrying part of it, because retail reacts very differently than institutional investors. What does this mean in practice? It means that when prices start falling, retail investors don't have sophisticated risk controls. They don't have algorithms that automatically hedge. They don't have diversified portfolios across multiple asset classes. They just have crypto. And when crypto goes down, they panic. Look at what happened in October. Over 1.6 million trading accounts were liquidated in 24 hours. That's not institutions getting margin called. That's over 1 million individual retail traders losing everything simultaneously. And here's the cascade effect. When prices drop 10%, leveraged longs get liquidated. That forces selling, which pushes prices down another 5%. That triggers more liquidations. Retail investors see their portfolios down 15% and they panic sell. That pushes prices down another 10%. Now you're down 25% total, and even unleveraged holders start capitulating. In the October crash, Bitcoin dropped 14%, Ethereum dropped 12%, and most altcoins dropped 40–70% before partial recovery. That's not rational profit-taking, that's panic. The Crypto Fear and Greed Index, which measures market sentiment, moved to extreme fear during the October crash. And historically, that's when retail investors do the most damage. They sell at the bottom, locking in losses while institutions buy the dip. But here's the problem for 2025-2026. Institutions aren't buying the dip like they used to. Spot ETF flows, which had been a structural bid for Bitcoin throughout 2025, turned negative during the crash. Major ETF trackers reported hundreds of millions in outflows. So instead of institutions providing a floor, they became sellers too. And the retail dominance creates another problem: herd mentality. When everyone in crypto Twitter is panicking, when every Discord server is screaming sell, when every Telegram group is posting liquidation screenshots, the psychological pressure to sell becomes overwhelming. BitGet's analysis of the Q4 2025 crash noted that retail traders bore the brunt of the losses. They also found that traders exhibited gambling-like rush and withdrawal-like symptoms when trying to stop trading high-leverage positions. This isn't investing, this is an addiction. And here's the historical pattern. In every previous crypto bear market, 2014, 2018, 2022, retail investors were the last to sell. They held on hoping for recovery. They bought the dip repeatedly as prices kept falling. And by the time they finally capitulated and sold, prices had already dropped 80–90%. The same pattern is setting up now. Retail investors are still holding. They're still believing in $200,000 Bitcoin by the end of 2026. They're still thinking, this time is different. But institutions know better. Market makers like Wintermute are offloading millions of dollars in Bitcoin and Ethereum on Binance. Large holders are reducing exposure. Smart money is de-risking. And when retail finally realizes that institutions have already left, the panic selling will be biblical. Because retail doesn't sell gradually. They don't scale out of positions. They hold until they can't take the pain anymore, and then they dump everything at once. So what does history tell us about where this is headed? The 90% crash historical pattern. Here's the historical reality that crypto investors refuse to accept. Crypto crashes 80–90% in every bear market. There are no exceptions. And all the signs point to it happening again. Let's look at the data. In 2018, Bitcoin crashed from $20,000 to $3,200, an 84% decline. Ethereum crashed from $400 to $80, a 94% decline. Most altcoins lost 95–99% of their value and never recovered. In 2022, Bitcoin crashed from $69,000 to $15,500, a 77% decline. Ethereum crashed from $4,800 to $880, an 82% decline. Luna went to zero. FTX collapsed. Dozens of coins lost everything. And now in 2025, Bitcoin hit $126,200 in October, and by December was trading around $86,000. That's already a 32% decline. If this follows the 2018 and 2022 patterns, we're only in the early stages of the crash. Analysts at Crypto News note that Bitcoin took 16–20 months to fully recover from the 2022 crash, and Ethereum took even longer. If the 2025 cycle copies that timeline, recovery could take 12 to 18 months. And Bitcoin could retest the normalized level around $77,500 before reversing. But here's what makes this crash potentially worse. In 2018 and 2022, there were specific catalysts: the ICO bubble popping, the Luna FTX collapses. You could point to specific events and say, that's what caused it. In 2025, there's no single event. Instead, it's a perfect storm of multiple systemic problems all converging: excessive leverage, 787B, regulatory crackdowns, SEC blocking leveraged ETFs, macro headwinds, Fed staying restrictive, market manipulation, Oracle attacks, retail panic, and negative ETF flows. Richard Murphy, an economist who analyzes financial bubbles, wrote in October 2025, "I have long suggested that the crypto market is all based on hype and has nothing to do with reality. I have also suggested that the crypto market is massively overvalued and due for a crash. Yesterday, that crash might have begun." He compared the October liquidations to memories of October 2008 and even October 1987, referring to two of the worst market crashes in modern history. And here's the data on similar historical patterns. Goldman Sachs analysts compared the current market to 1997, 2 years before the dot-com crash. They flagged 5 warning signs: peak investment spending, falling corporate profits, rising corporate debt, Fed rate decisions, and widening credit spreads. We're seeing all 5 in crypto right now. Deutsche Bank's Jim Reed, when analyzing OpenAI's losses, said, "No startup in history has operated with expected losses on anything approaching this scale." The same logic applies to crypto. No asset class in history has maintained such massive leverage and volatility without eventually collapsing. The mathematical reality is simple. Bitcoin's Relative Strength Index, RSI, has moved to levels not seen since February 2025, indicating extreme oversold conditions. But oversold doesn't mean ready to bounce. In bear markets, assets can stay oversold for months as prices grind lower. Bitcoin's MVRV indicator has also crashed, which historically attracts bargain hunters. But in 2018, that indicator stayed low for over a year as Bitcoin continued falling from $6,000 to $3,000. November 2025 was Bitcoin's worst month since 2022, with a 25% decline. December hasn't been much better. And analysts warn that if Bitcoin drops below the 80,000 support level, the entire bullish structure gets invalidated and the path to $50,000, $60,000 opens up. At $50,000, that would represent a 60% decline from the October peak. At $30,000, that's a 76% decline, matching 2022. And if we get a full capitulation like 2018, Bitcoin could touch $20,000, $25,000, which would be an 85% decline. For Ethereum, the picture is even worse. Ethereum historically crashes harder than Bitcoin in bear markets. If Bitcoin drops 80%, Ethereum could drop 90%. That would put ETH around $500, wiping out 95% of leveraged positions and destroying entire portfolios. The 90% crash isn't a prediction. It's the historical norm for crypto bear markets, and we're watching it happen in real time. So what should you actually do to protect yourself? Here's exactly what you need to do right now if you have any exposure to crypto, and I'm going to give you the specific steps that could save your portfolio. Step 1. Calculate your crypto exposure. Pull up every account where you hold crypto: exchanges, wallets, ETFs, and retirement accounts, everything. Add it all up. If crypto represents more than 10% of your total net worth, you're overexposed for a potential 90% crash scenario. Let's do the math. If you have $100,000 total and $20,000 in crypto, that's 20% exposure. If crypto crashes 90%, that $20,000 becomes $2,000. You just lost $18,000 or 18% of your entire net worth. That's devastating. Target maximum 5 to 10% crypto exposure. If you're over that, start scaling out now. Don't wait for one more pump. Step 2. Exit all leveraged positions immediately. If you're using any leverage, 2x, 5x, 10x, 50x, 100x, close those positions today, not tomorrow, today. The next flash crash could liquidate you in minutes, and you won't have time to react. Take your losses if necessary. I know it's painful. But taking a 20% loss now is better than 100% liquidation during the next cascade. Step 3. Sell altcoins first. If you hold altcoins outside the top 10, those will get destroyed first and hardest in a crash. Coins like Doge, SHIB, SOL, ADA, and anything with lower market caps could easily lose 99%. Move into Bitcoin and Ethereum if you want to maintain some crypto exposure. They'll still crash, but probably 60-80% instead of 95%. Or better yet, move to stable coins or cash entirely. Step 4. Set stop losses on everything. For any crypto you decide to keep, set hard stop losses. If Bitcoin breaks $80,000, that's likely the start of capitulation. Set Your stop's at $82,000 to $85,000, so you automatically exit before the cascade accelerates. Don't trust yourself to watch the market and sell manually. When crashes happen, they happen fast. You need automatic exits. Step 5. Build a cash position for the bottom. This is crucial. If crypto crashes 80–90%, there will be incredible buying opportunities, but only if you have cash ready. Keep 20–30% of your investment capital in cash or stable coins, waiting for the bottom. How do you know it's the bottom? Look for capitulation signs. Mainstream media declaring crypto is dead. Bitcoin fear and greed index at 10 or below, trading volume collapsing, and prices stabilizing for 3 to 6 months at deeply oversold levels. Step 6. Diversify outside crypto. Take profits from crypto and move into traditional assets, stocks, bonds, gold, real estate. Don't keep 100% of your wealth in one volatile asset class. Warren Buffett is holding $325 billion in cash. Michael Burry is shorting the market. Smart money is defensive. You should be too. Step 7. Accept reality. This is the hardest step psychologically. You need to accept that the bull market is over. The Bitcoin to 200K dream is dead for this cycle. The narrative that institutions will save us isn't playing out. Reality doesn't care about your hopium. Protect your capital first. You can always buy back in after the crash. So we've covered the 6 reasons why crypto is heading for a 90% crash. The leverage time bomb with $787 billion in outstanding positions. The October flash crash that proved the system is vulnerable to manipulation. The Fed rate reality that kills the bull case. The retail panic selling death spiral. The historical pattern showing crypto crashes 80–90% in every bear market, and exactly what you must do right now to protect yourself. These are the exact warning signs that smart money is watching, while retail investors keep buying the dip. But here's something I didn't tell you at the start of this video. Everything I just shared is completely useless if you don't know where to put your money after you exit crypto. Without understanding which assets will outperform during the crash and where to position for the next cycle, you could miss the recovery entirely or worse, lose money in other collapsing markets. Click this video over here where I break down the best defensive investments for 2026, which assets will survive the crash, and exactly when to buy crypto again at the bottom. I'll see you in the next one.